Well, the trajectory of the US economy is the most important driver for equity markets. With the Fed cutting rates, that trajectory should, well, accelerate from here. But then, of course, you do have the election of Donald Trump. Let's get the view from Jeffrey Schultz from Clearbridge. Jeff, good to catch up with you again. Of course, last week was critical for markets. We did have that rate cut again from the Fed, but of course overshadowed by the election of Donald Trump. Has this altered your view in terms of the investment landscape?
It has slightly. Policy matters in the short and intermediate term, but it comes down to the trajectory of the economy longer term. And while our view is 85% chance of a soft or no landing in the US over the next 12 months, the positive fiscal impulse that you're going to get from this election further boldens our view of that outcome transpiring. And when you look at the last 10 presidential administrations, 8 out of 10 of those presidents saw an annualized return of anywhere from positive 7% to 15%. The only 2 that had a negative return happened to be presidents that were bookended by recessions, which is President Nixon and then George W. Bush. So with the Fed cutting now 75 basis points in total, which matches what you saw in the 1995 soft landing and the 1998 soft landing, we think that this is a pretty positive concoction for an economy that continues to move forward, but also more positive U.S. equity gains into 2025.
So what do you make of the so-called Trump trade? Obviously, those assets that are perceived to do well under a Trump administration.
We think that there's more to it. Believe it or not, the beneficiaries of the Trump trade actually started to outperform on a relative basis on July 11th, once it became very clear with June's soft CPI print that the Fed could cut, and there was a high likelihood of this expansion continuing. So to put some numbers around it, the S&P 493 has outperformed the Magnificent Seven by 9% over the last 4 months. Large caps have outperformed small caps by almost 10%. Values outperformed growth by 7%. And the Trump trade has kind of accentuated this move, but given better earnings delivery because of a positive fiscal impulse, likely more tax cuts, potentially a lower corporate tax rate next year, we think that there's more to move on the rotation that we've seen. And again, we think financials, industrials, energy are all going to be areas that have a little bit more upside on a relative basis.
How do you weigh up those pros and cons potentially of the policies that Donald Trump has put out there? Of course, we don't know whether he's actually going to implement them. Nonetheless, obviously, expectations of tax cuts and deregulation broadly supportive, particularly for equities there. Whereas then you consider his proposals in terms of tariffs and how that would affect global trade. Potentially, that would be inflationary and may then mean that that rate cutting cycle is, well, brought to an end.
Well, we've been of the view that the markets were a little bit too quick to anticipate a large rate cutting cycle. So with the markets now pricing an additional 2.5 cuts by June of next year, we think that that's probably about right. We may only get 1 or 2 more cuts, but as I mentioned earlier, that's more than enough than what we saw for the 2 soft landing cutting cycles in the 1990s. But ultimately, we view that the extension of the Tax Cuts and Jobs Act, potentially a lower corporate tax rate, full expensing from an R&D perspective, it's going to benefit capex-heavy industries like technology, like healthcare, like industrials. We think that all of this, coupled with deregulation, is going to overwhelm some of the headwinds that you're going to see potentially from a lower immigration in the U.S. and then higher tariff policy.
Do you have a particular view just in terms of those sectors likely to benefit? I guess an obvious one would be energy, given his outlook there. I mean, it's all about growth, potentially could affect particularly the transition to renewables.
Yeah, believe it or not, even though Trump was a pro-energy president, energy, even before COVID happened, was the worst performing sector in the S&P 500. So just because deregulation is there doesn't necessarily translate to better equity performance. But ultimately, we think that you are going to see a headwind to some of the green energy initiatives that you have in the U.S., but a lot of that money that's been earmarked from the IRA is likely still going to be spent, because when you look at it geographically, most of that money is being spent in Republican areas, and there's going to be strong pushes from representatives from those areas to keep that spending intact. So while energy did get a boost because of deregulation after Trump was elected, unless you see materially higher energy prices, there may not be a lot more upside on a relative basis for energy. But I do think that the headwind that you saw to green energy was a little bit of a knee-jerk reaction. You could see a bounce back for some of those stocks looking forward over the next 12 months.
What's your view on small caps? Because we have seen that rotation underway. Do you expect that would continue?
We do, with an important view that the 10-year Treasury doesn't move materially higher from here. If you look at today's price action, for example, small caps did pretty poorly, and that's been with the 10-year Treasury rising back above 4.4%. I think small caps can continue to lead as long as the 10-year Treasury doesn't go above 4.6%. But after that level, because small caps are much more interest rate sensitive, I think that could be a headwind to their relative performance. But the reaction that you saw from small caps the day after the election, with the 10-year Treasury rising over 16 basis points, I think is a really good sign that with stronger economic momentum expected next year, you're probably going to have a broader earnings delivery, better pricing power, which will overwhelm any headwinds that you see from higher interest rates. So I think that small caps probably have some more room to run next year.
What's your view on the US dollar? Do you expect it's going to maintain its strength, and therefore what would the likely impact be?
Well, the dollar, I think, even though former President Trump wants a weaker dollar, I think that you're going to see a stronger dollar over the next 6 to 12 months. When you look at the tariffs that were put into place in the first presidential term, you saw a stronger dollar as a lot of companies offset the effects of tariffs with a weaker currency. The dollar is probably going to attract more capital as you have a greater interest rate differential between the Fed and other global central banks with a much more resilient economic backdrop and a stronger fiscal impulse. And I think if greater geopolitical uncertainty, attracts a safe haven bid to the dollar overall. So while some people believe that the dollar could weaken from here, our expectation is for it to strengthen modestly and potentially move even higher depending on what transpires on the tariff front.
So as we move towards the inauguration of Donald Trump mid-January there, Jeffrey, how are you viewing your portfolio construction just in terms of equities, fixed income, cash?
Yeah, so if you look at rate cutting cycles going back to 1980 when you've had a soft landing, the key view is to move out of cash and into U.S. equities. It didn't really matter where you went, but U.S. equities outperform cash by double or at least close to double, depending on where you're talking about. So with rates coming down on the short end of the curve, we think it makes sense to take on a little bit more risk. Our view is that you're likely going to see a 10-year Treasury that's range bound between, call it 4.25% and 4.75%. In that situation, you really want to be duration neutral, but you want to take on some credit risk as defaults are likely going to move lower. And from an equity perspective, I think you're going to want to have exposure to the cyclical areas of the economy that generally do well when you have higher nominal GDP growth and better earnings delivery. So that's going to be value, that's going to be small caps. And from a sector perspective, again, I think financials, even though they did well in the aftermath of the election, prior to the election, they were rallying because of fundamentals. Really strong third quarter earnings delivery. A steeper curve is going to help net interest income. You're going to have better loan demand and less losses in a healthier economic environment. We also see upside for industrials and some commodity related areas of the market spectrum and parts of consumer discretionary that aren't going to be affected heavily from a large increase of tariffs. So we think pro-cyclical leadership is going to persist at the expense of defensive leadership.
And dare I ask, Jeffrey, should there be any consideration of having exposure to crypto in your portfolio?
Well, based on the market price action and comments out of Trump during the campaign trail, it would suggest that crypto, even though it has embedded a lot of gains over the course of this year, could see further upside as we look out on the horizon.